Hey everyone, welcome back to Corporate Decoder, the place where we unpack the juicy secrets hidden within corporate filings. And oh boy, has SuperX AI technology dropped a report that has got more twists and turns than a roller coaster. Get ready people, because SuperX AI Technology Limited has just filed their annual report. And let me tell you, it is a wild ride from a humble interior design firm trying to pivot into the super competitive world of AI infrastructure solutions. We're talking millions in new investments, a name change or two, and some eye-popping financial numbers. Let's dive in and see what is really going on behind the scenes. Before we jump into the numbers, don't forget to hit that subscribe button and also join our awesome Discord community linked in the description below. It is the perfect place to keep the conversation going about these corporate deep dives. So SuperX AI Technology Limited, a company originally incorporated in the British Virgin Islands, has been busy. They started out offering interior design and fit out services, which is a pretty far cry from the cutting edge AI world they're aiming for now. In fact, they even changed their company name twice recently to reflect this shift. First to SuperX AI Technology Limited, and then to SuperX AI Technology Limited. It seems they are serious about their AI ambitions. Their corporate structure has also seen a lot of shuffling. They completed a reorganization back in 2021, essentially setting up SuperX as a holding company. Over the past couple of years, they've been snapping up subsidiaries left and right, including companies in Australia, Singapore, Japan, and even the US. This rapid expansion suggests a company growing very fast, very quickly, perhaps a bit too quickly if we look at the financials. Now, let's talk money. As of the 30th of June 2025, they had a massive 22,169,854 ordinary shares outstanding. That is a lot of shares, and it tells us they've been raising capital. Looking at their revenue for the fiscal year ending the 30th of June 2025, it was $3,596,575. That's up from $2,903,179 the previous year. But here is the interesting part. Their interior design business, which used to be their bread and butter, saw a drop in revenue of about 13.1%. So, where did the revenue growth come from? Well, they started selling AI servers and related equipment, bringing in over $1 million. This new AI hardware business is clearly a big focus. But that AI server business also came with a hefty price tag. Their cost of revenue spiked by a whopping 55% to $3,231,225 in 2025, largely due to the cost of goods sold for those new AI servers. This surge in costs, coupled with a drop in revenue from their older interior design business, meant their total gross profit took a hit. It dropped by over 55% to just $365,350 for the year. Their gross profit margin also tumbled from a healthy 28.2% to a much lower 10.2%. In simple terms, for every dollar they earned, they were making a lot less profit compared to the year before, especially from their core design business. This is a huge red flag. Their selling and marketing expenses also exploded, going from a mere $7,585 to nearly $590,000. This makes sense as they try to establish their new AI brand. But the biggest drain on their finances comes from general and administrative expenses, which shot up by over 538% to a staggering $11.8 million. A huge chunk of this increase is due to higher legal and professional fees, likely related to their IPO and ongoing compliance, but also a significant jump in share-based compensation, suggesting they are granting a lot of stock options. And then to raise the good part, the impairment of goodwill. They recorded a massive $9.3 million goodwill impairment charge. This happens when the value of an acquired company drops significantly below what they paid for it, meaning they essentially overpaid. This is a tough pill to swallow and signals that their recent acquisitions might not be performing as expected. All of this led to a net loss of over $21 million for the fiscal year ending the 30th of June 2025. That's a huge jump from a loss of around $855,000 the previous year. It shows that while they're growing, they're currently losing a lot of money doing it, especially after their recent pivot. They're definitely in a growth mode, but it is a very expensive one. When we look at their cash flow, things get even more interesting. For the fiscal year ending the 30th of June 2025, they used a whopping $8.3 million in cash from operating activities. This is mainly due to that huge net loss they reported, but also because they're spending money on things like prepayments for new equipment and leases. Their investing activities also show significant spending. They used over $12 million in cash here, mostly for new property and equipment, and also to invest in equity securities and provide loans. They seem to be investing heavily in their future. Thankfully, they brought in a lot of cash through financing. They raised over $30 million from private placements of shares and warrants, along with some borrowings. This influx of cash is what is keeping them afloat and funding their aggressive expansion. It is a classic growth company strategy, burning cash to build for the future. Now, let's talk risks, because this filing is packed with them. One major concern is how they rely on their subsidiaries to send money back up to the holding company, and there is always the looming shadow of Chinese government regulations potentially impacting money transfers, which could seriously hurt their ability to fund operations. Doing business in Hong Kong also comes with its own set of uncertainties, especially with the changing political landscape and potential impact of new security laws. They also highlight that it can be tough for overseas watchdogs to get the information they need from within China, including Hong Kong. Their interior design business is facing fierce competition, with many smaller players making it hard to stand out. Plus, most of their revenue comes from just a few major clients, which is always a risky situation if one of them decides to walk away. And for their shiny new AI business, the risks are substantial. They're dealing with high energy costs, reliance on specialized hardware like GPUs, the constant threat of cyber attacks, and the rapid pace of AI development, meaning their tech could become outdated quickly. Governments are also stepping in with new regulations on AI, data, and energy, which could add significant costs and restrictions. They're also betting big on their in-house assembly facilities, including their Japan supply center, but there are always risks with scaling up new operations. Let's look at their leadership. Yayman, Thomas Law heads up the CEO role, and Chan Kit Anderson Yu is the interim CFO, who also has extensive experience with public companies in Hong Kong. They've also brought in a new Chief Technology Officer, Kenny Sning Ho An, who has a strong background in it and AI from his time at Intel. This team is clearly trying to navigate this complex transition, and to keep their key people motivated, they've got a couple of equity incentive plans, the 2024 and the 2025 plans, allowing them to grant shares and options to directors and employees. This is pretty standard, but it also contributes to those rising administrative expenses we saw earlier. Now, for the auditors, KD & Company is their current accounting firm, but they've had a couple of changes in auditors over the past few years. This can sometimes be a yellow flag, but in this case, it seems they are now working with a firm that is subject to PCA-UB inspections, which is a good sign given the recent regulatory focus on foreign companies. Let's take a quick look at the balance sheet. As of the 30th of June 2025, their cash and cash equivalents had more than doubled to over $17 million. Mostly thanks to that recent capital raise. They also have significant loans receivable, suggesting they are lending money, perhaps to fund some of these new ventures or acquisitions. But their accumulated deficit, which is basically their total losses since inception, has ballooned to over $22 million. So, while they have cash, they are deep in the red. The statement of operations really highlights that massive net loss of over $21 million in 2025, a huge increase from the previous year. This drop in profitability is directly linked to their strategic shift and the associated costs, and the cash flow statement confirms it. They used nearly $8.4 million in cash from operating activities in 2025. Without that massive financing inflow, they would be in serious trouble. Their aggressive acquisition strategy is evident in the SuperX Industries acquisition. They spent a significant amount, including a large chunk in contingent consideration payable, which is essentially an IOU based on future loan recoveries. This highlights the complexity and uncertainty of their growth strategy. On top of that, the $9.3 million goodwill impairment charge is a clear sign that the market's perception of their AI business, or at least the value of their acquisitions, has diminished. It is a stark reminder that rapid growth through acquisition can come with significant risks. Now, for my take, SuperX AI Technology is in a high-stakes game. They're trying to transform from a stable, albeit less exciting, interior design business into a player in the incredibly dynamic and capital-intensive AI infrastructure market. Their strengths lie in their ambition, their aggressive fundraising, and bringing in experienced leadership for this new chapter. However, the risks are significant. The massive increase in operating expenses and the resulting huge net loss, coupled with the goodwill impairment, are serious concerns. Their reliance on high-risk, high-reward AI is a gamble. They've bet big on this pivot, and right now the numbers show they are burning through cash to get there. The success of this strategy hinges on their ability to execute quickly in the AI space, manage their rapidly growing costs, and generate substantial revenue from these new ventures. Right now, the story is one of significant investment and ambition, but also significant financial strain. Can they pull off this technological reinvention? Only time will tell. Alright. That is our breakdown of SuperX AI Technology's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.